Hey everybody, Marty Mazzora here. It's the 12th of July, 2024 with your weekly video update. We'll talk a little bit about the economy and inflation, then we'll get into some market stuff. And I'll jump right in with the University of Michigan's Consumer Confidence Survey. That's the green line here. That continues to, I'll say, plummet and support our narrative that recession odds are not small here if you've got, say, a 6-month-ish outlook. And by the way, our index actually rose 2 points. That was all about sector dynamics, and I'll show you a quick chart here in a second. So in terms of the economy, here's that economic surprise index for the U.S., and you can see it's very depressed. And that means that the data continues to come in somewhat weaker than what economists had earlier or previously estimated. CPI came out this week. That is what kind of set the market off yesterday. Again, very interesting dynamics internally yesterday. But headline CPI came in at 3% year over year, negative, down 0.1% month on month. That sent yields way lower, sent gold way up, sent silver way up, and sent stocks other than the big averages that everybody's been loaded up in, up as well. Core went down a bit, but still 3.3%, rose 0.1% month over month. Today, producer prices came in. They were actually above expectations, 0.2% on a month-on-month basis, and headline and core 2.6 and 3.0%. respectively. So market didn't react much to that, but that was a little hotter than expected, whereas CPI came in cooler than expected the day before. The one indicator that improved for us, that gave us that 2-point increase this week, was the staples to discretionary stock ratio. Remember, this was through the moon. As of just a couple of months ago, the spread was a full 10%. Right? Discretionary was actually negative on the year, while staples were up a bunch. Well, that's come back about down to even. So discretionary stocks, being oversold and probably somewhat shorted, have gotten quite the boost to where both are up now about 7% year to date. So staples are still doing well, but they're not sending that economic signal that says the economy is in trouble. The signal being, when staples, things you got to buy to stay alive, versus discretionary, the things you buy when you have extra money, stocks outperform. When staples outperform, that suggests people are only spending on what they have to. Well, whether or not people are spending more, notwithstanding, you've had this big run up in, and I think really just oversold discretionary stocks. Now, sentiment is getting a bit scary again. So folks, remember this. We've been working this chart for a long time. I showed you heading into the 2022 bear market, we had a lot of bullishness, not much bearishness, and then market rolled over from there. And I show all these points where, bullishness was spiking and people are loading up on one side of the boat. Here we were when we had that decent correction in 2023, even though it was a good year overall. And then heading into 2024, looked pretty ominous. And again, it's funny to say that because this means that there's just loads of optimism. But of course, when everybody is crowded on one side of the boat and you get some opposing news, well, then they all run away at the same time. So that held up pretty well until about right here. Again, spread was a little bit narrower than it was here. And there we got that 6% correction that we were actually calling for. Although I said like 5 to 15, so it barely went down more than 5. Well, folks, we're kind of sitting here again, right? Really, really close to those levels. Yesterday, market kind of scared some people. Again, NASDAQ was down 2%, but it felt big. But folks, make no mistake, a 2% drop in the NASDAQ, given what it's been doing, is really nothing. It's profit taking, and I think rotation among big hedge funds. You'll see what I mean here in a minute. The other thing that is concerning from a sentiment standpoint is the Investor Intelligence Survey. Now, this has been a really, really good historic indicator. And it's that bull-bear spread is what we track in our sentiment index. And you can see it sits at 44.8%, more bulls than bears. And it's the danger zone above 40%, right? So yeah, here's just a chart. It goes back 2 or 3 years in the S&P. Here's that bull bear difference way up here, right? Last time it was up here, we got that dip. Typically it's high before we get big dips as well. So sentiment is a red flag right here. Talked about that here a week or 3 ago when I talked about our monthly analysis, our equity market conditions index. And we had 7 of our 9 indicators were either neutral, most of them were bearish, but 2 huge ones, yields and the dollar, were bullish for stocks. And I'll update those charts for you here in a second. Okay, so quickly the technicals. Busy, forgive me, but busy chart. This is that daily chart of the S&P 500, and we just keep climbing this rising wedge pattern. In here, there's that big down candle yesterday, but you can see we've recaptured it and some a little bit today. Long divergence, still somewhat bearish. We could break out above that. Pretty overbought here on the RSI. I keep looking at this weekly chart. You can see still climbing up this very classic rising wedge pattern here and trying to break out above it. And we still have bearish divergences in terms of trend on the momentum indicators. That is a buy signal right there, but this is a bearish divergence. You have a higher price, lower price on the momentum, and then you've got somewhat of a bearish divergence on the relative strength index, and you're in overbought territory. And as I keep pointing out, you got to be careful when you're overbought on the weekly chart, right? Boom, 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 right here before that 2022 30% drop. And that's where we are right now. So we'll see. Just I guess a catalyst would be needed. The Qs, the NASDAQ 100 ETF, broke out below that rising wedge with a big, ugly down candle yesterday, capturing about 2/3 of it back so far today. We'll see if the Qs, the NASDAQ 100 ETF, can fight its way back. Just coming down off of some overbought territory that got cured by that big blue candle, which is a down candle right there, and about to burn through this bearish divergence if we can get another up day or 3. So interest rate probabilities. So we had that weak CPI number yesterday, and suddenly we are now pretty much a full-on chance of a rate cut in September, right? In fact, they're pricing in 1 rate cut. I would bet on that. I've been talking about that a lot the last month or so, that we expect a September rate cut. You can see that odds favor another one in November or December. Leaning towards 3 cuts this year right now based on the present data. 2 makes a lot of sense to me, and we'll see between now and the end of the year. We've got 3 priced in leading into January of next year. We think the economy is going to get worse, and the Fed will be cutting interest rates probably a number of times over the next year or so. Speaking of the Fed cutting interest rates, now I've made the case that that's going to be bullish as it begins to occur, right? And so the prospects for that yesterday across most stocks, today, and even the big concentrated averages, it's bullish. The market is anticipating that Fed rate cut will be bullish. Now, that's potentially a very costly mistake. So this takes us all the way back to the mid-70s, where we had significant periods of the Fed tightening, raising the Fed funds rate. And what happens when they begin to cut? So you can see in late 1979, to combat inflation, the Fed was raising interest rates, and when they started cutting, almost within a matter of weeks, it looks like we had that early 80s recession. Paul Volcker and company panicked right in here finally as the recession was really grabbing hold, and they panicked and they cut interest rates, and we still had a very structurally higher inflation backdrop back then, and they had to take interest rates to the moon again and ultimately create another recession. My point here, though, is that when they're cutting, typically it's because we got problems. So we had a lot of volatility in here, and again, fear over a new inflation spike. But then we started raising rates here. Here we cut again, right? We did end up in that early 90s recession. We raised, cut a little bit in here, but then we raised, and when we cut significantly, or when the Fed did, boom, you had that early 00s recession, which culminated in an 80% drop in the NASDAQ and a 50% drop in the S&P, by the way. And then constant Fed hikes, right? Flatness. This looks a lot like what we're having right here. Constant hikes, flat pause there for a while. First rate cut. And within a very short period of time, the Great Recession, 60%, call it, down for the S&P. Here we were, hiking rates, started cutting them in the fall of 2019. That's exactly when our recession light got lit. And we had the COVID recession, which would have been a doozy, except for the fact that, if you add the fiscal and the monetary, something like 10 or 11 trillion was brought to bear. And so here we are fighting the inflation that resulted from that, also from structural forces that I write about a lot. In fact, wrote about it in this week's written commentary. And here we are, folks, preparing for a rate cut here in a month or three. I still would maintain that, looking at how the market's trading, that as that happens, we could see bullishness in equities like we are right now. That could play itself completely out by then. But ultimately, if this runs true to form and this turns into recession, stock valuations, I can say with an exceedingly high degree of confidence, will not hold up at these levels in a recession / falling corporate earnings environment. So stay tuned for that. Okay, so I thought I'd look at the Russell 2000. We haven't looked at small caps in quite some time because they absolutely soared yesterday and today as well. What a gap. I think they're up like 3.5% yesterday. I read somewhere there's only been one other time in history where the S&P was down 1% and the Russell was up 3%. And I think it was Dave Rosenberg, who's a very bearish economist right now, said, yeah, everybody's talking about that, but they're not talking about the fact that the S&P went down 20% over the next, 6 months or a year or something after that day. I don't think that means a whole lot. I do anticipate something like that, if not worse, not necessarily because of the action yesterday. The action yesterday, quite frankly, in our view, folks, came from the fact that the Russell 2000 was majorly shorted, right? So this is net futures positions on the Russell 2000 as of last week in non-commercial, aka speculator portfolios. So they were significantly net short the Russell like they haven't been, in 2 years or so. And then we also look at asset managers and leverage funds. And I believe it's the asset managers that are net long, but it's come down quite a bit. Leverage funds are substantially net short. So yesterday, big time futures traders, hedge funds, etc., way short small caps. Small caps are very interest rate sensitive. So you had that weak CPI, you had interest rates fall. So you had small caps get bid because we have all this dangerous short interest. All the while, you have now, at least for the last 3 weeks running, significant long interest. This is the last reading. This one just came out here just a little while ago, but it's as of Tuesday. The big fall was yesterday, so it'll be interesting to see what happens next week. So we had pretty big long exposure going into that CPI report. So clearly you had big monies rotating out of the NASDAQ and tech stocks and into small caps and just about everything else, quite frankly. Okay, so as I said earlier, the majority of our inputs to our equity market conditions index, something that we put together a few years ago, were bearish, except for two that are critically important the way the market is trading, hence our near-term on-balance bullishness, and that is the dollar was looking very weak technically, and you can see what it's done since then, right, the last 2 weeks roughly. And so we made that call right up in here, and this is what it did, and I said that would be bullish for stocks. Said the same thing about yields, right? Yields looked bearish. We had a sell signal here. So again, the two positive for stocks have really played out, and those are very critical, like I said, to how the market has been acting. And then last but not least, because I wrote about it this last week, and that is the yen. And let me just pull over that blog post, actually this week. You should have got it Wednesday, those of you who subscribe. So the yen, here's what I wrote. As I look across all asset classes each week, the yen is bursting off the screen, right? Per the below, it sits at multi-decade lows. This is a monthly chart. Those of you who've been watching my technical videos, on this monthly chart, very compelling falling wedge, very compelling bullish divergences in the MACD and the RSI. Simply put, it's historically undervalued, purchasing power parity among consumers. The yen is massively cheap relative to the dollar. The Big Mac index, which basically adjusts a la currency in each country for what the cost of a Big Mac would be. Fly to Japan, you're going to get a cheap hamburger relative to what you'd pay in the US. So the yen very undervalued on that metric. And it's shorted big time. Non-commercial, asset managers, and leverage funds are profoundly short. Now remember, they're borrowing futures contracts that they have to buy and give back. So this is all ultimate buying, right? If we get something like a weak CPI report and falling US interest rates, or strong Japanese data, or Japan finally having enough with their seriously weak yen, and they are intervening at times, but the kind of macro or monetary policy that would push the yen up. I am bullish on, say, a 1 to 2 year horizon in a not small way on the yen. Given the massive amount of carry trades, probably don't need to get in these weeds that much, but smart people will borrow in the yen at like zero interest rates, go invest it in another currency where they can get a nice spread. Maybe they're making 5 or 10% on money that's essentially free. Well, that's great as long as the yen behaves itself, because those are loans. They got to be paid back. So if the yen rises, while that investment that the yen was traded for in another currency, if the yen goes up against that currency, those carry trades can be a disaster. If the yen were to rise, say, more than 5% against a trade that is giving a net 5% yield, they're going to lose money, and they could lose a ton if the yen really takes off. So my point is that when you have a period where it looks like the yen's going to jump, or it looks like the global economy has got some issues that may make a stable currency like the yen stronger, people will repatriate, and then you get these massive moves because suddenly these trades are reversed, everybody rushes back to the yen, and it goes up. So while I suspect we're early, and I do, notwithstanding yesterday's big bounce in the yen, and it's bouncing again today, it makes nothing but sense to scale into our yen ETF position, which we did. Still not a huge position for us. It will be bigger, I'm pretty certain, as we go. But you want to do things carefully in this uncertain environment. I mentioned that the yen will be a very nice hedge. I think it will probably outperform even the dollar during the next recession. BCA research agrees with us. Then I said, well, the rising yen will be a tailwind in dollar terms for Japanese equities. It'll be a headwind for Japanese multinationals. On net, I suspect it'll be bearish for Japanese equities. They were down over 2% last night. So that seemed to make sense as well. So with regard to how the yen looks technically right now, this is the daily chart. Sure enough, we came screaming out of that falling wedge pattern, and right now we're testing some very key moving average resistance and a very key level right here. Big, strong buy signal on the MACD. Now, having said all this, folks, I'm talking about the next year or two. This could come barreling right back down over the next couple of weeks very easily. I'm not making any short-term prediction. I am saying, though, that longer term, I think there is significant upside for the Japanese yen relative to the US dollar. So, folks, I'll let you go there. Thank you, as always, for watching and listening. Hope you have a wonderful weekend, and I'll talk to you again next week. Bye-bye.